Hey everyone, and welcome back to another video for today. In today's video, well, first of all, thank God it's Friday, right? We're going to have a look at the current state of the market. I do want to touch on the Meta story again. We talked about this on Thursday, but I do want to touch on it yet again because it does get quite ridiculous. We'll talk also about SoFi, the announcement from yesterday. We've got some, well, cybersecurity news. So if you're looking at your favorite cybersecurity names, probably right now they're all down quite a lot. You might ask, why is that? Well, you can point the finger yet again to the usual suspect, which is Anthropic's Claude. And then we'll close out the video by talking about, well, what you could be doing, what you should not be doing right now. We'll look at a couple of specific names because, I mean, nothing is really safe, right? People say, oh, look at this stock, it's down 40%, trash company. Well, even if we look at the very popular big names out there, they're also down significantly, right? SoFi is down over 40% year to date. Robinhood is down 40% year to date. Of course, Duolingo is down more than that, but even a Microsoft is down quite a lot. Even a Meta is down quite a lot year to date. So we're going to have a look at a couple of names. I think those will be very interesting. Of course, let me know down in the comment section below what you're putting on your watch list. Maybe you're just raising cash, what you've been buying. Let me know all of that in the comment section below. If you enjoy this type of videos, you know what to do. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So right now, before the market opens, probably by the time I'm ending the recording, the markets will be open, but right now you can still see quite a lot of red. Meta is down another 1.5%, Microsoft another 1.2%, Google 1.4%, Nvidia 0.6%. So still a lot of red here. Netflix is up 1.4%. Why is that? Well, they are raising prices yet again. We're going to have a look at an analyst note on that. It's still around $93, $94 per share. We do have here a note from Evercore ISI, Mark Mahaney, puts an outperform rating on the stock. Well, that's maintained, and the $150 price target is maintained here as well. The key takeaways are as follows. Survey across US and Japan shows continued pricing power, strong engagement levels supporting subscriber retention, churn remains resilient, only 31% are highly likely to cancel after a $1 increase, and 48% report low likelihood to cancel, indicating higher price tolerance. Now, of course, since the start of the 2010s, of course, the price of a Netflix subscription has gone up substantially. We all know that. But in this case, we can also say that, yes, the price has gone up substantially, which we don't like. We don't like to pay more for what seems to be the same thing. But in this case, I don't think it's the same thing because the content library has increased quite a lot. They've added live shows, they've added sports. So they've added some extra things on the platform in order to justify the price increases. Again, I know many people don't like the price increases, but you cannot tell me that you're paying for the exact same product. Yes, it is a streaming app, but the content, what you're getting from it, in my opinion, the value has increased throughout the last couple of years. Has it increased as much as the price has gone up? Okay, that's debatable. Moving on, or moving back to the Meta discussion we've had yesterday. So Meta and YouTube found negligent in landmark social media addiction case. A jury found the companies harmed a young user with design features that were addictive and led to her mental health distress. We've covered that yesterday. We've talked about that. Look, I agree. And I've said yesterday, and I'm a shareholder of Meta. I'm a user of Meta products as well. But I agree. Yeah, I do think that young kids, extremely young kids, shouldn't be on social media. They should be out there with their friends. They should not be stuck with their phone. Easier said than done. I know I'm not a parent, but that's my opinion. Now, in this case, first of all, there are already, as I've said yesterday, there are already things that you can do in the settings of Instagram in order to protect from such things. Right? You can put a time limit, even if you are under 16. I think under 13, you're not even allowed. Under 16, you need permission from a supervising parent, and that supervising parent can also control the amount of time that you spend on the app. So there are things that have been put in place in order to protect, of course, younger users. Now, can these platforms do even more? Yeah, Probably. But this case right now, of course, it opens up a Pandora box. But then again, people have been saying, oh, this is like the tobacco cases that we've seen a long, long time ago. Yes and no, because yes, there are also a lot of positive things that can happen on social media. Now, this also can lead to, let's say you're a parent and your kids are addicted to Mr. Beast's content, because Mr. Beast's content is targeted towards younger folks, right? Maybe adults watch it as well, but you can say, oh, my kid is addicted to Mr. Beast's content and this led my kid to do XYZ. Or my kid is addicted to McDonald's or Frito-Lay products or whatever, and this is why this happened. Well, first of all, yes, these products, these fast foods, snacks, things, well, they're good and very popular because you could say that they are addictive. So are we going to go to every single company out there that has made a very good product? Okay, maybe not that healthy, Big Macs and Cheetos and things like that, but are we going to go to every single company right now and say, oh, look, my kid is obese or my friend is obese, people are laughing at him, fat shaming, it's because of you, it's because your products, you know that your products are very addictive and still you sell those? Well, we would like some money for it. How's that going to work? It's not going to work. And so if you're going after Meta and YouTube for this thing right here, yes, this opens the door to going after everything else that has been very successful out there that might have some addicting, well, features to it. And then what? I don't know what's the end game here. So I do think it is sort of an overreaction. I do want to see more action happen, more things happen towards protecting kids on social media. But this whole doomsday scenario around Meta right now doesn't make any sense to me. I do view this again as a sort of Google 2025 type of thing where, oh, they will be forced to sell Chrome and Android and things. No, I don't think that's going to happen. Now we do already have, again, the same analyst here from Evercore ISI. Outperform rating reiterated. $900 price target is maintained. The key takeaways here, and we do get some data here. 8 to 13 age group estimated to be mid-single digit % of the 3.6 billion daily active users. The platforms prohibit users under the age of 13. Child safety concerns are not new. We know that. Social media provides benefits across communication, entertainment, and connectivity. Okay. Valuation at around 16 times PE, near 3-year trough after correction. That's probably, that's the forward one. But yeah, in my opinion, this is an overreaction. Unfortunately, and we've said that and we've seen that with a lot of the big tech names, is that I do think we are going to see this more and more. Depending also on who's in charge, we are seeing a lot more attacks towards the big tech companies. And I don't see how that does not continue over the next couple of years. And as we've seen yesterday, you can see that Meta is back to prices not seen since April 2025. There is a little gap up that happened here. So that gap did get filled. This is on the daily. We are, of course, oversold. If we go and look at the weekly, RSI is low, but it's at the lowest level since November. November, we've also seen a correction, as you can see right here. But here we did a rebound on the 100-day moving average. In this case, right now, we are a little bit in no man's land between the 100 and the 200-day. The 200 sits at $438. Are we going to go that low? I don't know, but if we do, I would probably buy an insane amount of shares. And since we are talking about Meta, of course, part of the Mag 7, we have here Santova on X, the magnificent 7. That's what we get right here. So from the peak to now, we have Apple that's down 11.3%. We have Nvidia that's down 18.1%, Amazon 18.6%, Alphabet 18.8%, Tesla 24.4%, Meta 30.3%, and Microsoft 33.8%. Now, since this is again from the 52-week highs, we can always say that maybe it should never be trading at those 52-week highs. And now we're back to normal prices. Although I would say that in some of these cases, I don't think the prices right now are that normal because these companies just keep getting better and better. Yes, we do still have this. What's the return on investment on all of the CapEx? Well, okay, fair question. But it should maybe never be at the 52-week highs, but I also think we are maybe a bit too much on the downside right now. Although some people might disagree, that's completely fine. But just to show you that, yes, even the best companies on the planet are experiencing a nice pullback. We've been talking more and more about maybe focusing right now on those big players because, yeah, if you do feel uncomfortable right now, why not go for these extremely profitable, very, very strong companies that are trading at very attractive prices instead of trying your luck with, well, yes, maybe future potential multi-baggers, which is still fine, but maybe now the percent of allocation should change in these types of situations. Maybe the potential multi-baggers, yes, have more upside, but if you can get an Nvidia at 21 times forward earnings, a Meta at below 20, well, sub 20 times forward earnings, things like that, and Amazon at the cheapest price it has been since 2008, that's according to Jeffries, why not? Why not buy these amazing companies, sleep much better at night, and then when maybe sentiment in the market, maybe macro improves, then you start to switch, or you just keep those positions, of course, and you allocate maybe now a little bit more cash towards those lower cap companies with more growth potential. Why not? Switching to the cybersecurity names, as you can see, Palo Alto, CrowdStrike, Zscaler, Okta, SentinelOne, Fortinet, Rubrik, they're all down 6, 5, 4% right now on a Friday. Of course, these companies, these stocks have taken a huge, huge hit also from their all-time highs. As you know, cybersecurity names have always traded at quite a big premium. And so, as you know, as we've just said, right now, maybe they're just trading at the correct price. And so what's happening right now? Why is there yet another overreaction in that sector? By the way, you can put the cybersecurity name in the SaaSpocalypse category. Well, it's because of the usual suspect here, Anthropic Claude. So this was apparently a leaked document review or whatever that was released. We have finished training a new AI model, Claude Mythos. It's by far the most powerful AI model we've ever developed. Of course, they say this every single time, but in this specific case, they do talk about cyber defense, cyber security. So Mythos is also a large compute-intensive model. It's very expensive for us to serve and will be very expensive for our customers to use. We're working to make the model much more efficient before any general release. In preparing to release Claude Mythos, we want to act with extra caution and understand the risk it poses even beyond what we learn in our own testing. In particular, we want to understand the model's potential near-term risks in the realm of cybersecurity and share the results to help cyber defenders prepare. Now, you might start to think already and say, okay, I don't see why this is a bad thing for cybersecurity companies. Well, first of all, as you know, there are different cybersecurity companies. The reason why I like Rubrik a lot is because Rubrik already assumes that attacks will happen. Rubrik already assumes that breaches will happen. And so when these things happen, you will need your second line of defense, which of course is what Rubrik does. So in my case here, I view this as quite a positive thing for Rubrik. And as for all the other companies out there, the CrowdStrikes, the Palo Altos, of course, they're also using AI. But in this case, what the market fears right now is that it will become extremely cheap to attack companies, and it will become increasingly more expensive to try and defend. Now, okay, that's what the market might be thinking right now, but I do think that this whole cybersecurity space has always been a cat-mouse, right? Tom versus Jerry type of story. We release a new product, we try to defend against the existing threat and the future threats as well. You try to attack us, we try to defend, etc., etc. Inside those companies, they're also trying to attack their own solutions. Some people say that the cybersecurity companies create viruses in order for their products to sell more, which, okay, I guess makes sense. But right now, it seems like, yes, the market is saying, just like with all the other software companies out there, what premium, what price can these companies start to ask other companies if, well, in this case, Claude starts to release their own solutions, and their own solutions are much cheaper than what a CrowdStrike, what a Palo Alto, what a SentinelOne might offer. Although I do think that these companies will use Claude, will use AI in order to make their own solutions much better. But right now, it seems like the market doesn't really care that much. And so this is basically what we're getting right now, more pain in the software, in this case, in the cyber security space. But as you can see on Friday, now that the market is open, you can see that when most of the names are red, what is green is, surprisingly, it is Micron, but not so surprising because we talked about that yesterday, how this could be as the DeepSeek moment for the memory space, where we're just going to see an increase in demand for memory and not a decrease because it becomes maybe more affordable and more efficient. Moving on to one of our favorites here, and that's SoFi. As you can see, SoFi is now experiencing a drawdown of 52.8% since it reached a high here in November, well, mid-November of 2025, where most of the growth names, the names that were flying quite high, reached a peak. A 52% drawdown, yet the company becomes better and better. It's probably a good thing to point out. On the daily, it is oversold right now. It's under $16 per share, despite announcing something quite positive on Thursday, and that's this. SoFi expands loan platform business with multiple new agreements totaling over $3.6 billion. So SoFi closed a loan platform business transaction with a leading global bank for an extended loan delivery of over $1 billion and a separate loan platform business transaction with a financial services and insurance group for $600 million over 12 months. Additionally, SoFi agreed terms on a new partnership with a top 5 global private asset management firm expected to deliver up to $2 billion over a 2-year period. Anthony Noto said the following thing: adding 3 new partners to our growing network shows the unique value of our loan platform business to asset managers, institutional investors, and partners more broadly. By connecting strong borrower demand with institutional capital, we are building a capital-light, fee-based business that complements our overall lending business while leveraging our existing technology platform capabilities in underwriting, pricing, marketing, and servicing. In 2025, SoFi's loan platform business secured over $10 billion in commitments to meet strong borrower demand. That didn't stop the stock from falling further. Now, what's interesting is that if we go back to 2025, and actually in Q4, they generated around $194 million from the $3.7 billion. That's a 5.2% take rate. On an annualized base, that's $775 million. We have around $14.8 billion annualized loan platform business volume. Again, take rate will take that around 5.2%. So if we look at what's been announced yesterday, we can say that at a 5.2% take rate, this will generate $135 million approximately, maybe even a little bit more, in incremental annual revenue. It's quite something, no? Right? And this is just from one announcement. This is just right now. And yet again, the stock just dropped even more, even if they announced that this is going to, based on our assumptions here, increase by $135 million in incremental annual revenue. We also had 2 analysts that came out to defend SoFi more recently, one from Goldman Sachs. Neutral rating maintained and price target of $25 was also maintained. Key takeaways: loan platform business commitments over $3.6 billion, expand funding capacity, $1 billion from global banks, $600 million insurance deal, and up to $2 billion from the asset manager partnership over 2 years. The analyst sentiment here is neutral. They view the funding expansion positively, but maintains balanced stance. Well, they see 57.6% upside based on the current price that we're at right now and their own price target. Then we have, of course, a fintech bull here from Mizuho, Dan Dolev, maintained their outperform rating and $38 price target. That's close to 140% upside from the price we're at right now. Here as well talks about the new loan platform business partnership, strong institutional demand help ease consumer credit concerns, personal loan performance concerns alleviated by new deals, strong Q4 results and upbeat guidance support the outlook. I'm not that surprised. I am also not that surprised that, well, all of these analysts have come out actually with a more positive stance or maintain their positive view on SoFi, despite the BS Muddy Waters short seller report that came out a week ago. Yes, the stock did go down, but as we've seen the day that the short seller report got released and even the day after, I don't think the short seller saw the move that they were expecting. Right? Yes, it did drop sharply 5% at one point, but then towards the close, it did recover quite a lot. Of course, right now we are lower than before. We are lower than when Noto bought even more stocks, but it's more macro related than, oh, the business is a fraud, the business is doing bad. And that's the thing with a lot of the names right now. A lot of these names have seen, yes, some a more serious pullback than others. If we look at the year-to-date performance, we can see a lot of red. Yes, there are, of course, some pockets of greens, but you can see a lot of red even in companies that have very, very profitable businesses. Some call it monopolistic. I mean, even if we talk about a MasterCard, a Visa, a FICO, these types of companies. FICO, for example, Emir, good friend of the channel, will release a more up-to-date report on that. So if you are subscribed to his newsletter, his research pieces, expect a new FICO research piece to come out. But the whole thing about FICO, for example, is that, oh, FICO increased the price by 700% or something like that. Yeah, okay, the 700% looks very scary, but the dollar amount is not that big. And also as a percent of the overall cost, right? I don't think it has any impact on, oh, expensive mortgages and things like that. But since it is a figure, a number that is very much visible, it is much easier to attack a FICO than to attack everybody else that did also increase their prices by quite a lot. And the dollar amount that they're increasing has a bigger impact than that small dollar amount increase from pulling a FICO score. And so right now, as always, there are always two ways to think about this. One, you don't want to do anything. You are just keeping your cash to see when the situation starts to become a little bit more stable, when maybe things are already recovering. That's completely fine. You can also play with options, of course, selling covered calls, collect the premiums on a weekly basis, so the bleeding doesn't hurt that much. That's also a possibility. Or the other possibility is, okay, you've been raising enough cash, you see good deals, and you start to accumulate more and more shares. Someone asked me in the portfolio update video about, oh, why not put a big amount of money already right now instead of doing small buys here and there? Well, because of the situation that we're in right now. Because I don't know where the bottom is. That's the thing. I'm not trying to time the bottom. I'm seeing good companies trading at very attractive prices. And so, yes, every single week, I'm adding a little bit more that position, a little bit more in that position, accumulating more and more shares. Because my end goal is, of course, to own as many shares as possible in the companies that I like. And as you've seen, that doesn't stop me also from cutting companies from my portfolio. If I see that suddenly other positions are way more attractive, I will cut the positions that are maybe right now still good companies, but less attractive compared to what I am owning at the moment. That's also something that you learn along the way, because I know cutting positions from your portfolio, especially when those are losing positions, sometimes feels like the bad move, but history showed me that it's usually the good move. And so all in all, that's about it for me in today's episode. Let me know what you think down in the comment section below. Share your thoughts and maybe concerns down there as well. Hope you all have a wonderful weekend. See you all in the next one. Bye-bye.